or losing time. Minervini discovered through studying thousands of winning stocks that 95% of the biggest gainers made the majority of their profits while in stage 2 uptrends. This isn't opinion, it's statistical fact. The best time to buy a stock is when it's making new highs, not when it's cheap. Let me show you exactly how this works with his famous stage analysis. Every stock goes through 4 predictable stages, and Minervini only buys in stage 2. Stage 1 is the neglect phase, sideways consolidation, where the stock builds a foundation. Stage 2 is the advancing phase. This is where all the money is made. The stock breaks out and trends higher with institutional accumulation. Stock 3 is the topping phase, volatile distribution, where smart money exits. Stage 4 is the declining phase, where most retail investors lose everything. Here's where most traders get it completely wrong. They see a stock that's dropped 50% and think, what a bargain. But Minervini proved this thinking is a recipe for disaster. Instead, he looks for stocks that have a strong run higher and are building what he calls a volatility contraction pattern near their highs. The logic behind the volatility contraction pattern, or VCP, is surprisingly intuitive. Imagine a stock that has already made a strong run higher. At some point, it pauses, and instead of continuing to surge, it begins to move sideways, consolidating its gains. What's important is how this consolidation unfolds. The first pullback is usually the widest. Price might retrace around 20 to 25%. Then, as the stock stabilizes, the next decline becomes noticeably smaller, maybe around 12 to 15%. A third contraction follows, often limited to single digits. Eventually, pullbacks shrink to just 4 or 5% before buyers step in again. Each time this happens, price swings become tighter and tighter. At the same time, trading volume often fades. This combination sends a clear message to the market. Selling pressure is being absorbed. From a behavioral standpoint, it makes sense. Early profit takers have already exited. Weak holders have been pushed out during the larger pullbacks. What remains are more confident investors who believe in the stock and are willing to hold through minor fluctuations. As volatility compresses and volume dries up, the balance between supply and demand quietly shifts. By the time price approaches the upper end of its consolidation range, most of the available supply has already been consumed. When price finally breaks above that range and volume returns, the move can be powerful. Demand overwhelms supply, and the stock often enters a new phase of acceleration. Many of the strongest historical winners showed this behavior before their biggest runs. In Minervini's work,